This channel is for educational purposes only. Make sure you do your own due diligence before making any investments. And there is inherent risk in trading, so it's speculative. Just make sure you keep that in mind. I'm going to be on Stock Charts TV on Wednesday afternoon, so keep an eye out for that. It's going to be for the Daily 5, give a few stock ideas, maybe talk about a few things. Hi, this is Joe Rabil with Invest Like a Pro. We're going to talk about exits today, and I think you need to understand how important the exit strategy is to your success. If you're a short-term trader, then the entry and the exit are equally important. If you're a longer-term trader, I would argue that your entry or trigger is even less important than your exit strategy. I think you could be very successful finding good setups without maybe the perfect trigger if you have a very good exit strategy. And there have been back tests done by certain guys in the industry that have shown that you could do, if you're in a stock or a market that has some activity or the potential for some movement, and you take a random entry on it, if you have a good, consistent exit strategy, you can be successful over time. So that's what I want to talk about today. And I'm going to use Microsoft for the example. And, just before you even start thinking about it, I know that this is a stock that has had a phenomenal move, but you got to realize I'm using a longer term stock. You can do this for a weekly and daily combination as well, not just for monthly and weekly. And the thing I wanted to distinguish is if you're a short-term trader, if you want to play for like a swing trade, you're trying to buy compression and sell expansion. You're not necessarily looking to just milk a trade and milk the trend. But I'm going to show two trades today, both from Microsoft. One is a long-term base breakout pattern, and then the other is a pullback pattern. And those are the two key ones. I think if you learn how to handle the breakout pattern and then learn how to exit a pullback strategy. And I think if you do that, you're going to have a lot of success and you'll be very consistent. So I got this chart. I've got a monthly chart of Microsoft on the left. I've got a weekly chart on the right. I've made markings on here. I think the markings are easier to see on the weekly chart, but I wanted you to be able to see. I wanted to write this down so you can either take a screenshot of this and maybe print it out or something like that so you can really see and go back and use this as a framework. I'm not necessarily telling you that you have to do it exactly this way, but some version of this is going to help you be so much more consistent. The other thing I want to mention is if you notice when I go through this today, I don't talk a lot about selling on divergence or, if a stock looks like it's making a big climatic top and I just exit. For the most part, I don't use that kind of an exit strategy, again, unless I'm trading. If I'm trading and I buy something and it makes a quick little pop and maybe I buy it one day and the next day it gaps up, I'm probably just going to sell the whole thing if my intentions were that it was a short-term trade. But if I'm looking to try and milk a trend, basically I consider it a trend trade at this point, then I'm not going to get too overly consumed by the day-to-day movements or divergence patterns or price resistance even. Price resistance might play a role in helping me define the target, but it's not going to tell me to just exit. And again, a lot of this has to do with the fact that I'm doing a lot of the work beforehand. Okay, so let's get into this now. And I just want to go back. So the entry I'm talking about in Microsoft is a base breakout. This went sideways for 10 years, 12 years. And then it finally emerged out of this area to the upside. And I've shown where the entry is crossing above this key area here, above this peak. And again, at that point, it doesn't probably look very timely. If you look at it on a weekly chart, it had already made a pretty decent sized move. It wasn't like I got perfect entry, and I purposely did it this way because I wanted to just show if you're going to buy a stock coming out of a big base. My suggestion is buy it as close to the breakout point as possible. And this was within about a point of the breakout level. And then give it a little room. I use 10% as a basic barometer for a stop level when I'm doing a trend trade off the monthly and the weekly. And so at 10%, I can give it a little bit more wiggle room if the stock tends to have a little bit more volatility, and a little less than 10% if it is a little less volatility than that. But use 10% as like as a starting point. And if you notice, I've got this green line going across showing the entry. It was right around $38. And I have written all of this down here. And my initial stop, again, is around 10%, which is where I've put this red line. And what you're trying to do when you put these trades on is get to 1R. 1R is the distance between your entry and your initial stop, is that distance. So in this case, I bought it at $38. My stop is around 34, something like that, 34 and change. I'm using round numbers just to make it easier. Call it $4. And if I'm up $4 in the trade, I want to take 25% of my shares and sell them. So if I bought 260 shares, which is a $10,000 position, and I risk $1,000 by using a 10% stop, at the first target, I'm going to sell 65 shares at 42, and I'm going to take a profit of $250 at that level. And then on the balance of the shares, I'm going to raise the stop to break even. And then at 3R, you take another profit. So again, I've written all this down on the left. Once you get to 3R, now you're at a break even. Now you've taken $1,000 worth of profits on an initial risk of 1,000. You still have half of your position in place. And the worst you can do on the balance of the shares is break even. So when you get yourself in this type of position, you've got basically a free trade on, because you've made profits in the initial shares. You're out of half, but you still have half of the position left. And as it continues to climb, you're going to make money on the balance. Now, at 6R, meaning 6 times your initial risk, you take another 65 shares, another quarter piece off. At this point, you're taking about a $1,500 profit. And then when you get to that point, I want you to raise the stop to 3R. And that's where this line ends and this one starts, just to show you. And so I actually added in another when you get to 10R, 10 times what you initially risked. Then you'd raise the stop to 6R. And these are hard stops. Put them in on your system. If you have a couple hundred shares, literally put them in on the software, put a stop in, good till canceled, and forget about it. Don't sit there and look at it every day. If you're trying to trade longer term, please turn off the monitor. If you're looking at your stocks intraday in a stock you're trying to hold for a length of time, you're going to eventually just get out based on the volatility. There's way too much intraday volatility to be able to handle that kind of movement. And any normal person would definitely get to the point where they're very, very uncomfortable seeing the swings that take place. And if you look at what Microsoft did, there are massive swings along the way. Once it finally got going, it really didn't have much of a retracement. But you can continue to trail the stop, and I would actually recommend using a 40-week, give it enough room, and then I'm going to show you what happened. You would have probably been stopped out, if you used the 40-week, you would have probably been stopped out around 100 based on the break of the 40-week. Now, I'm going to show you, and this is actually the pattern. It's the last chart in my book, Invest Like a Pro. I wrote a book, and I talk about this pullback trade. This was the last chart I used as an example, was this Microsoft pullback. And what I wanted to show here is, so I actually just plugged in just the initial entry and the initial stop. I'm not going to follow through on all the other, but even though this is just a pullback trade and not breaking out of a big base, I still want to handle it the similar way. When I get 1 times what I risked, I want to take profits. Now, it's your prerogative how you handle this. Maybe you want to take a third in this type of a trade because you're not always going to get a massive move like you will out of a big base breakout. But you can still do it the same way. Take a quarter off, and then go to a break even. And then at 3R, go ahead and take another quarter piece off and keep it at break even. And then when you get to 6R, and in this case, if I risk $10 in this trade, 6R would be 160, which would have been way up here. I'd go to 3R and have my stop at 130 basically, or I'm sorry, 140. And so, you're going to continue to trail stops based or hit targets along the way, but you would have probably been stopped out on this wild movement to the downside. Listen, this isn't the end all be all. It's not going to get you, it's not going to make you better at getting bigger wins unless you allow these things to play out. In other words, if you're following your plan and you're looking for big base breakouts, or you're following your plan and you're looking for really quality pullbacks, you're going to get your share of wins. It's a question of how much, the size of your win versus the size of your loss. And you always want to average anywhere from 1.75, really more like 2 to 1 in terms of the size of your win versus the size of your average loss. And you got to be able to track this stuff. These are really important key points. Make sure you keep a log file so that you know how you're handling these positions over time. I hope this was helpful. Please hit that like button, and we'll talk to you soon.